Ladies and gentlemen, welcome to this episode of my tutorial video channel. The subject of this video is cost and management accounting, and the topic is marginal costing, that is marginal costing, profit planning and decision making part 2. In part 1, I have solved numerical problems on profit planning and decision making of one type, and in this part I shall solve another numerical problem by using marginal costing technique. To be precise, the CVP or cost volume profit analysis. Now CVP is a very powerful tool to study the behavior of the profit with respect to changes in cost, volume of sales and sales price. We shall apply the CVP analysis to answer these questions. The problem is given as, look at the whiteboard please. Sales 1,000, variable costs include direct material 300,000, direct labor 300,000, factory overhead, that is variable factory overhead 80,000, and variable marketing expenses 70,000. So total is 750,000. So contribution is this minus this, that is 250,000. Now come to fixed costs. The fixed costs are fixed factory overhead 50,000, fixed marketing expenses 30,000, fixed administrative expenses 20,000. So total is 100,000. So net profit is contribution minus the fixed cost is 150,000. Right? Now we have to answer these three questions. Number 1, compute PV ratio and break-even point. Number 2, compute PV ratio and break-even point if fixed cost increases by 10,000. And number 3, in a modernization proposal, fixed cost to increase by 25,000 and reduce direct material and direct labor cost by 25,000 each. That means there is a proposal for modernization, in which case the firm has to incur additional fixed cost of 25,000, which will in turn result in reduction of variable cost, that is direct material cost and direct labor cost, by 25,000 in each category. Right? So now I am going to answer these three questions. Number 1, compute PV ratio and break-even point. Solution number 1, PV ratio and PV. Contribution you can directly find out from the given problem is 250,000. PV ratio is equal to contribution over sales into 100 is equal to 250,000 divided by 1,000 into 100. Right? That is 2,50,000 divided by 10 lakh into 100. This is simply 25%. So PV ratio is 25%. Correct? The formula of PV ratio is contribution by sales, either total contribution by total sales or contribution per unit by sales per unit. Both will give the same answer. So here we have put the value of total contribution and total sales, and we have computed the PV ratio as 25%. Now in this part, in this problem number 1, we have to find out BEP also. BEP, break-even point. Now look, since here nothing is mentioned about number of units, so we cannot find out the break-even point in terms of units. So we shall compute break-even point in terms of sales or money value. So break-even point in money value is fixed cost, you can write plus 0, because at break-even the firm is neither earning any profit nor incurring any loss. So fixed cost plus 0 by PV ratio. So how much is the fixed cost? 100,000. So 100,000 divided by 25%. Let me use the calculator. Let's see what it comes to. $400,000. So the BEP sales of the firm is 400,000. That means by selling 400,000, the firm will be just able to cover the total cost. The firm is not earning any profit nor incurring any loss also. Now come to part 2. What is that? Compute PV ratio and break-even point if fixed cost increases by 10,000. Now what is the current fixed cost? The current fixed cost is 1 lakh. Now it is expected to increase by 10,000. So here also we calculate PV ratio and break-even point with increased fixed cost of 10,000. Right? Now you see there won't be any change in PV ratio because PV ratio formula does not contain fixed cost elements. What is the formula PV ratio? Contribution by sales, and contribution is what? Sales minus variable cost is contribution. That divided by sales into 100 is the PV ratio. So whatever increase or decrease in fixed cost is made by the firm, there is no effect on the PV ratio. So PV ratio is equal to C by S equals to 250,000 divided by 1,000 equals to 25%. Now BEP. Now BEP will certainly change because the formula of BEP contains the fixed cost. So BEP in terms of sales or money value. So BEP equals to fixed cost by PV ratio. Now what is the new fixed cost? Earlier the total fixed cost was 100,000. Now 10,000 will be added to it because the firm is increasing. The firm is expecting that the fixed cost will increase by 10,000. So fixed cost will be 1,10,000 divided by PV ratio 25%. So let us see what it comes to. $440,000. 440,000. So the BEP has increased from 400,000 to 440,000 as a result of increase in fixed cost by 10,000. So part 2 is done. Now come to part 3. What is part 3? In part 3 it is proposed that by incurring additional fixed cost, maybe by installing certain machines or any other technology, the firm is expecting that there will be reduction in direct material cost and direct labor cost by 25,000 in each category. That means the current direct material cost is 3 lakh, so it will be 2,75,000. In the same way, direct labor cost is at current level is 3 lakh, so it will also reduce by 25,000 and it will become 2,75,000. Right? So, number 3, proposed change and effect on profit. There is no change in sales, so sales will remain as it is 10 lakh. Less variable costs, direct material will be 2,75,000, direct labor will be 2,75,000. Currently it is 3 lakh, and by implementing the new proposal, it will reduce by 25,000, so it will become 2,75,000. Variable factory overhead will remain same. How much? 80,000. And variable marketing expenses will remain same at 70,000. So total variable cost becomes 275,000 plus 275,000 plus 80,000 plus 70,000. So it comes to 7 lakh. So new contribution will be same sales figure minus decreased figure of variable cost. Previously it was 7,50,000, now it is 7 lakh. So total contribution will be 3 lakh. That is, total contribution will increase by 50,000. Previously it was 250,000. Okay. And what will be the fixed cost? Fixed cost will increase by 10,000. So fixed cost will increase by 25,000. So previously fixed cost was how much? 1 lakh. Now it will become 1,25,000. Fixed cost is increasing by 25,000, and as a result, direct material cost and direct labor cost each will decrease by 25,000. So total variable cost has decreased by 50,000. So we deduct fixed cost from the contribution. So we get profit. How much? 3 lakh minus 125,000, that is 1,75,000. This is the profit. Previously profit was 1,50,000. Now it is 1,75,000. Correct? So what is the PV ratio? In respect of the modernization proposal, PV ratio is equal to 1,25,000 divided by, what is the PV ratio? C by S, that is 3 lakh by 10 lakh, 125,000 divided by 3 lakh by 10 lakh is equal to 125,000 divided by 30%, right? So this will be 125,000 divided by 30%. Divided by 30%. So it comes to 4,16,666. 416,666. 416,666. Sorry, I beg your pardon. I have to erase this part. Sorry, I beg your pardon. PV ratio is equal to 3 lakh by 10 lakh, 30%. Therefore, BEP, I made both in one step. So BEP will be, how much is the fixed cost? 1,25,000. 1,25,000 divided by 30% equals to 416,666. So this will be the new break-even point of the firm if the new proposal is accepted. That is 4,16,666. So all these three questions are answered. The whole problem is solved. What we have done? Firstly, we have computed the PV ratio and break-even point. PV ratio is contribution by sales into 100, and break-even point in terms of sales, because we cannot find out the break-even points in terms of unit because nothing is mentioned about the units. So PV ratio is equal to contribution by sales into 100. That is 25%. 25%, and break-even point is fixed cost plus 0. You can write 0, or you can simply write fixed cost by PV ratio, because at break-even point the firm is neither earning any profit nor incurring any loss. The firm is just able to recover the total cost by the revenues. So break-even point is 4 lakh. Now come to number 2. Compute PV ratio and break-even point if fixed cost increases by 10,000. Now, as a result of increase in fixed cost, the PV ratio will remain unchanged because the formula PV ratio does not contain fixed cost. So PV ratio will remain 2,50,000 by 10 lakh equals to 25%, as in question 1. But BEP will certainly change because the formula of BEP contains fixed cost. So BEP is fixed cost by PV ratio, and fixed cost is expected to be increased by 10,000. So it was 1 lakh, now it will be 1,10,000. So BEP will be 1,10,000 divided by 25%, that is 4,40,000. This is the new break-even point if fixed cost increases by 10,000, other things remaining unchanged. Now come to part 3. What is part 3? In part 3 there is a proposal of modernization which says that the firm has to incur additional fixed cost of 25,000, maybe in new technology or new machine, and as a result of implementation of the proposal, direct material cost will fall by 25,000. In the same way, direct labor cost will also fall by 25,000. So the total variable cost will fall by 50,000, and the total fixed cost will increase by only 25,000. And we have to find out the PV ratio, break-even point, and profit if the new proposal is accepted and implemented. So third part is proposed change and effect on profit. Sales remains same at 10 lakh, less variable costs, variable cost, direct material cost and direct labor cost both will reduce by 25,000 as per the proposal. So previously it was 3 lakh each, now it will be 2,75,000 each, and variable factory overhead and variable marketing overhead will remain unchanged, that is at 80,000 and 70,000 respectively. So total variable cost is 7 lakh after accepting the proposal or implementing the proposal. Okay, so total contribution is sales minus variable cost, that is 10 lakh minus 7 lakh, that is 3 lakh, less fixed cost. How much is the fixed cost? Previously it was 1 lakh, now it will increase by 25,000, so it will become 125,000. So total profit, net profit is contribution minus fixed cost, that is 3 lakh minus 125,000 equals to 175,000. So this is the net profit if the new proposal is accepted. Now we find out the PV ratio and break-even point. Here there will be change in PV ratio as well as break-even point because variable cost as well as fixed cost both are changing. What will be the variable cost? Total variable cost 7 lakh. So contribution is 3 lakh. So PV ratio is contribution by sales, that is 30%. Previously it was 25%. Now it has increased by 5% percentage point to 30% as a result of reduction in variable cost, that is reduction in direct material cost and direct labor cost. So PV ratio has increased from 25% to 30%. And what will be the BEP in terms of money or sales, money value of sales? Money value, that is fixed cost by PV ratio. What is the fixed cost? 1 lakh plus 25,000. 125,000 by 30%, that is 416,666. This is the break-even point of the firm if the new proposal is accepted, right? So this is all about this numerical problem on marginal costing, profit planning and decision making. I hope it is well understood by you. Still, should you have any doubt in your mind, if you have any query in the back of your mind, please feel free to let me know through the comment section. I shall be more than glad to respond to all your relevant queries and doubts. And if you think this video has benefited you, please do share the video with your friends, brothers and sisters. And of course, thank you very much for watching this video. And finally, stay well and goodbye.